Now, one of the ways they control the world is derivatives, and everything comes back to derivatives. And as I've said for years, if you want to be right, any financial conversation you get in, just answer any question with derivatives, and you'll be right. It all comes back to derivatives. That's what it's all about. So, when you look at the Greece problem, Greece has a tiny economy relative to the world. Their debt is fairly small relative to the rest of the world. And if the best thing could happen, they could just declare bankruptcy, default on their loans, go about their business, redo their economy, and Greece would be fine. They would recover. But they're not going to be allowed to, because all of that sovereign debt has derivatives and credit defaults tied to it, and these credit default swaps are owned by the banks in Germany and the banks in France, and to a large degree, the banks in the U.S. and the insurance companies in the U.S. And the way this all works, it gets tentacled out so quickly because the Holy Grail now is a security. As long as you have a security, now you've got the Holy Grail. The security is the sovereign debt. Once you've got the sovereign debt, you can package that up and begin to sell defaults and swaps and expand the credit supply very quickly. This is simply my own rendition of these collateral mortgage obligations back in the days, and these guys are still out there, by the way. So if you had this security, you could sell a derivative, but if you sell a derivative, you're guaranteeing the people that buy the derivative, if it goes bad, you'll give them their money back. So you buy some insurance called the credit default swap to cover that derivative. Now whoever you sell the derivative to can sell another derivative, but they're going to buy a credit default swap because they know it's garbage too. So everybody knows it's garbage, so you're selling derivatives and buying swaps. And you can see this formation right here, this triangle, or as we like to call it, a Ponzi scheme. That's basically what it is. And the sad part of this stuff is these credit default swaps are sold by some of the insurance companies like AIG and so on. They turn around and buy a bond insurer product. And these bond insurers don't have any money. So, as you carry out this process, if this guy down here said, yeah, I kind of just want my money back, the whole Ponzi scheme falls down because there's no money behind it. But suddenly, in this little simple example, we've gone from $100 to $1,500. Now we have 15 to 1 leverage. God knows how much leverage is out here in a lot of the sovereign debt. The U.S., by the way, is exactly the same as Greece or anybody else. We can carry on as much debt as anybody's willing to write credit default swaps to let us carry on. So that's what it's really all about. And by the way, this is where the big banks make all their money on swaps and derivatives. They're not lending it out. Anyway, this is one of the most important charts I think anyone's ever going to see. When we talk about derivatives, this is a really, really important chart. And this is a chart of earnings of the S&P 500 companies over time. And as you can see, Black Tuesday 1930, of course there was no S&P. I think these are basically Dow equivalent stocks, which we might consider the S&P back in those days. But as you can see, we were earning about 20 bucks a share. Now we're earning 78, but here's the critical part. You can see over time earnings have gone up, up, up. Then they had this huge crash down, even below where we were on Black Tuesday 1930. And then we had this instantaneous recovery of earnings. How did this happen? Well, as you remember, in 2008, President Bush and his group said, you know, the way derivatives work is you can basically put any number you want to. Once you want a derivative, you can just write down a number and say that's what it's worth. That's mark to fantasy. Let's go to mark to market, meaning let's make everybody put a price on these derivatives according to what they could truly get for those derivatives if they sold it. So these companies went out in the market and found out they were pretty much worthless. So the earnings went straight down. Now, what do we do to fix these earnings going straight down? Well, we decided to go back to mark to fantasy. Put whatever number you want. Bang, came right back up. That's the only thing that happened. It's just derivatives. Now, tomorrow if we wake up and somebody says, let's go back to market, the earnings are going to go straight back down again. Because this is where everybody's making money on derivatives, and every company has derivatives. Every single company, big and small, chock full of them. You can't even open an annual report anymore without reading about derivatives. That's just the way the world works. Oddly enough, you know me, I like to do a little investigation. You know about inflation, right? Well, if we say $80 in earnings, and I forgot what the number is, you know, the talking heads on television are talking about the S&P making $85 or whatever this year in earnings. Well, what does that equate to in 1930? Well, $80, excuse me, $80 in 2010 earnings is only $6.13 in 1930 purchasing power. So effectively, what we're talking about is the real earnings, absent inflation, should be way down here somewhere. So in effect, our companies are actually worth less than they were back here on Black Tuesday.